with Moss Adams Capital. We are the investment banking group of Moss Adams. We help companies sell their business, buy a business, raise capital, either debt or equity. And of course, as you can imagine in this environment, we certainly are seeing a number of conversations around financing options, Main Street lending program and whatnot. And so happy to be here today to help lead the discussion. Jason, you wanna go ahead?
Absolutely. Thank you, James. My name is Jason Gill. I'm a senior relationship manager with First Federal Bank here in Port Angeles, Washington. And we've seen quite a bit of interest in Main Street here in the state of Washington. And that's a state that we're actively lending in. We're a 100-year-old bank, or nearly a 100-year-old bank, publicly traded, that's headquartered in Port Angeles, Washington. Thank you, and I'm happy to share all my thoughts on Main Street today.
Yeah, good morning, everyone. My name is Dhaliwal. I'm also a partner with Moss Adams. I help lead the agribusiness practice for our Northern California region. I'm headquartered in our Sacramento, Stockton offices, but my client base spreads everywhere from Chico all the way down to Southern California and into the Salinas Valley. We've had a lot of dialogue with bankers and clients of late on this particular topic, specifically the Main Street lending program, as well as some alternative financing options, and really happy to be here with you all this morning to chat about this.
Thank you, Jason and K-Deep. And just a quick reminder that this material is for informational purposes only and should not be construed as advice of any kind. As you all can imagine, Main Street Lending Program, PPP, it's all changing very rapidly. And so we need to just be cognizant of that. What we're going to talk about here, Main Street Lending Program, senior bank lenders and in-house loan products that are available to companies, junior and equity capital providers. We won't plan to touch on the PPP and the Economic Injury Disaster Loan Program. There's a tremendous amount of data and webcasts out there on those programs. Those are also alternative options for companies here today. Just a quick overview of the Main Street Lending Program. $600 billion mandate from the Federal Reserve Bank to loan to small and medium-sized companies. This is a loan that is going to be purchased 95% by the Federal Reserve Bank. The remaining 5% would be held by the eligible lender. Eligible lenders are US FDIC institutions. Last we checked, there's about 260 participating banks in this program. Eligible borrowers, businesses with up to 15,000 employees, $5 billion in revenue. So really quite the gamut here in terms of size ranges and the program types. There's 3 loan types. There's some similarities between the 3 and some differences, but by and large, all 3 loan types are 5-year loan terms. The minimum loan size is $250,000, and the maximum can be up to $300 million in certain situations. The principal is deferred 2 years, and then there's 3 payments at the end of year 3, year 4, and year 5, with a bullet in year 5 of 70%.
Yeah, come on in.
And interest rates are 3%, LIBOR plus 3%. There is some key limitations to think about here with the program. The borrower must commit to refrain from using proceeds to repay other loan balances, other than, of course, mandatory payments. And importantly, borrowers will also have restrictions on executive compensation above $425,000, really changes to executive compensation above $425,000, and restrictions on distributions and stock buybacks above and beyond normal tax distributions. So that's a high-level summary of the terms of the program. There's an FAQ out there publicly available, an 80-page FAQ out there that gets longer and longer, but that we'll touch on here later. But what we wanted to really spend some time on here is talk about what are we seeing in the market with the Main Street Lending Program. And there's really two common situations that are coming up here. So I'll talk on the left-hand side of the page here. Company profile, performing fine pre-COVID in 2019 and year-to-date 2020. Negligible COVID impact on performance. either no impact, negligible impact, or it's been a positive for their performance. Visibility into 2020 and 2021 remains strong. And these companies have significant access to debt and equity capital markets. There are lenders that have a number of loan products that fit these types of borrowers. Then on the right-hand side of this chart here, I'm going to paint a different company profile for you, one that had questionable performance pre-COVID or was performing fine pre-COVID, but had COVID significantly impacted the operations of their business. They had high leverage heading into 2020, 3, 4, 5, 6 times EBITDA. The lack of visibility into 2020 and 2021 is significant, with COVID wreaking havoc on their business, and these companies have limited access to debt and equity capital markets. The PPP and the EIDL program really the best fit programs for these businesses and have been widely consumed by these types of businesses. And then there's the Main Street Lending Program that originally was meant to cast a very broad net, but what we found is there's really more limited circumstances where it's a fit for companies that we interact with on a day-to-day basis. There are situations where it is a fit, and we're going to talk about this here. Jason, K-Deep, Jason, why don't we start with you? Maybe you can anecdotally provide some examples of companies you've seen approach you about the Main Street Lending Program, ones that have been a fit and ones that have perhaps not been a fit.
For those that are a fit, we've definitely seen some. I've gotten 2 that have been approved by First Federal. They're in the queue to be funded by Main Street, so I'll describe generically what those fits are. I had a fish processor that had 40% of their revenue coming from the restaurant industry, but they had a stable balance sheet, consistent earnings prior to COVID, and we went in and took out their existing revolver. And in this street, in specific in street, Main Street was a perfect fit because they could really use the year of no payments to get back on their feet and transition more from restaurants to retail. They did have 60% of their revenue coming from retail pre-COVID, but now it's substantially all retail. So that was a great fit, and we hope to fund that within the next day or 2. I did have another opportunity for a company that actually wasn't impacted by COVID, but the structure of Main Street worked really well for them. So they are a manufacturer of hardwood floors that go into residences. And they had historically only done manufacturing out of China, but they had always wanted to move some operations into the US. This 1 year of no payments was an ideal fit because we could upfront fund their capital needs for equipment and for getting a new plant up and running. And while that period of time was happening, they didn't have a payment required. And there is no specific requirement in Main Street that says that you have to be impacted by COVID. And then the last example was a contractor that makes, does heavy industrial like road making and such. And they had to shut down for 8 weeks. Their business was not materially impacted other than the 8 weeks of no revenue. And again, Main Street was an ideal fit for taking out their working capital line and their equipment financing that they had at their prior bank. Some good examples of ones that don't fit. It doesn't ideally work for real estate. And the reason is that there's a 15% principal payments in years 3 and 4. So you're basically during that period at something similar to a 7.5-year amortization. Real estate amortizations are typically 20 to 25 years. So that payment's just typically too steep for those that are heavy into real estate. Really any real long-term asset, Main Street's not an ideal fit. We're really looking for assets that are probably 10 years in length or less. And then there are, a variety of businesses that have approached us that have been heavily impacted by COVID. And it's just difficult to determine when they're going to be back to profitability. Our kind of rule of thumb is if you can show something that's believable, that shows within 12 months that you can make it back to profitability, then you can make the interest-only payments in year 2. And then we're very interested in pursuing those opportunities. So that's a good sketch of what I've seen in the market and some of the opportunities that are working and some that aren't.
Very, very helpful, Jason. Thank you. K-Deep, what about you? What are you hearing? You interact with a number of business owners and CFOs. What are you seeing in the market?
Yeah, so because the Main Street program was effectively tied to the CARES Act, I think the initial response was there's going to be some type of subsidy here, or there's some kind of government backing, similar to how the PPP loan was working, right? And then I think once the market started to digest kind of the terms of these loans and how they would work, there really became a clear line between what companies would be a good fit and which ones potentially would not be. The companies I've talked to, I would put them in, and this chart does a nice job in kind of segmenting the two different financial states of a company. And the one particular example of a company that I thought was a good fit and is pursuing this is a large-scale growing operation. It's a family-owned growing operation, multiple entities, not highly leveraged. They've got an operating line of credit, but not a whole lot of long-term term debt. And so they've been in generally pretty good financial standing. They're able to demonstrate that they may have had some kind of hit to margins during the last 4 or 5 months, but nothing that they expect to be a long-term impact. And they're really looking to recapitalize their business, looking for potentially a short-term financing option, and then maybe entering into some kind of long-term agreement with a bank. And so they seem to be a pretty good fit, and the few banks that they spoke with tended to agree, and I think they're moving along pretty well in that process. And then on the other side of the equation, there's been companies, one particular vertically integrated kind of tree nut processing company that has been hit not just by COVID, but a tightening commodity price in the almond industry. They were already pretty leveraged, and they didn't have a great long-term capitalization plan. They were looking for short-term money to kind of weather the storm. And that one potentially is not a good fit and not getting a whole lot of traction with the banks that they've spoke to. So I think the takeaway for me so far has been that while this program is potentially tied to the CARES Act and has some favorable financing terms, the companies that were already doing pretty well and can show that this has been a short-term impact are going to be able to qualify. And if they're looking for a short-term financing need, but if the company's been suffering pre-COVID, it's going to underwrite very similarly, as normal financing would, and they may not qualify.
Yeah, I think that's well said, KD. One additional, I'll give an example of one where the MSLP works, and it's a smaller tech company that does business process improvement software. And smaller company, 400,000 of EBITDA, 700,000 of total funded debt, and they are growing this year from last year. That's a prime example of a company that could potentially take out a $1.6 million, $2 million MSLP loan and so they're talking with Chase Bank and other banks. I've seen other situations where the EBITDA in 2019 was positive, maybe 2, 3, 4 million, distributor of oil and gas products, 3, 4, 5 million of EBITDA last year, and now this year they're losing 2 million of EBITDA through the first 6 months of the year. While technically they will qualify for the 2019 EBITDA requirement for the MSLP program, we're seeing banks pass on that one. And again, PPP and EIDL are going to be the better fits for those types of situations. So you've got challenges here on both sides of the coin here with this program. It is a fit for certain circumstances, no question. I think Jason gave good examples. Katie did. I've given you a few examples here. But again, if you're a high-quality buyer, a borrower that's got a lot of access to debt capital markets, there's probably going to be other loan products out there that are going to be more competitive for you. And then if you're having significant impact here from COVID, the PPP, the EIDL are probably going to be a better fit for you. There's a couple questions that came up here, Jason and Katie. It's a common question that I get as well, and it has to do with refinancing as part of closing on this loan. Are you allowed to refinance your existing debt into an MSLP loan as part of a closing? Jason, that's my understanding. Have you seen that as well? And Jason, I think you're on mute.
Yes, that's a great question. There are different rules for whether you're the existing bank or whether you're the new bank that's taking on new debt. So if you're the existing bank, you need to keep all existing facilities in place. And then you can approach your bank and ask for additional facilities under MSLP. If you're the new bank, so in our case as First Federal, I'm always the new bank because we have a pretty small market share in C&I in the state of Washington. So all my examples are new bank examples. In that instance, you've got new skin in the game. So the way the Main Street looks at it is you're making a loan and you just need to duplicate the collateral that was in existence by the prior bank. And then you can refinance not only that debt, but any other debt that may be out there that you feel that is within your risk tolerance. There was a question too that came across my screen that, would a new bank be interested in just providing Main Street financing and keeping existing facilities in place? The answer to that question, at least for our institution, is no. We would want a first position on all collateral in order to do the Main Street facility. So we're interested in paying off at least everyone that's got a broad form filing, and in certain instances, we'll pay off equipment as well.
Yeah, that's well covered, Jason. I think that's been a confusion for a number of folks, and I think the summary takeaway is if you're going through your existing bank, they cannot refinance as part of any existing loans that are lent to. Correct, Jason?
That's correct.
Yeah. So it's probably a good segue here to this next page. Is a little bit of an eyesore, but we wanted to list this is publicly available, the banks that are participating in this program. And we listed, this is not a comprehensive list, but it does list the banks from Washington, Oregon, California, Colorado, and Texas that are participating in this program. Overall, about 260 banks nationally are participating. That is a small percentage of the total banking industry that's participating in this. Jason, maybe you can give a little color about who's participating, who's not, and why that might be.
Great question. Thank you. I can speak to the state of Washington, where I'm really familiar with what's going on. The only major institution that has publicly stated that they're participating is Bank of America. So they're out there pursuing Main Street. And in our state, there are 9 banks that have publicly disclosed that they are participating in the program. There's likely around 60-ish banks in the state of Washington. So it's about 1 out of 5 or 1 out of 6. And I think the reason for the hesitation from the banking community is the banking community is a little unsure as to what the economics are for them. I think it's a great program for the borrower. The terms are super flexible. The interest rate in most cases, unless you're a really strong company, is very favorable. And the banks are looking at it and going, well, we're just essentially kind of brokering money for the for the government, because we're only taking 5% of the exposure and we're participating in 5% of the economics. We at First Federal look at this as a long-term play to get new, great companies into our portfolio, and at some point in the future, they'll approach us and we'll do 100% of the exposure for whatever their credit needs may be. But I think that's the reason for the hesitation from the banking community, is they're just unsure as to the economics, and they're also unsure as to, taking on the government as a partner. The government's a great partner in that they have a super low cost of funds, and that's passed on to the borrower. But, because we're taking collateral, we're looking at this as a deal that, is going to kind of stay on the books for the 5 years, because the government is not in a position where they want to, trade in or out collateral as, new needs come along.
That's well said, Jason. Katie, you spent a lot of time in the California market and talked with a number of these lenders. What are you hearing?
Yeah, it's been quite the mixed bag. It seems like the national banks are participating. The regional banks, I would say half are and half are not down here, and then the same would go for the local banks. I would say, in general, all the bankers I've talked to in all three of those segments have said that they've just been so bogged down with the PPP loans, with EIDL loans, that MSLP has been kind of an afterthought for the longest time. And now that they're coming out from under that, with the PPP loans, they've kind of got their footing, and now they're moving in more of a helping clients with the forgiveness aspect of it. They're now looking into this MSLP program. But some of the comments that I've heard from banks down here is that, we've got other products that potentially are just as competitive as this program, depending on the client's needs. And why would we take on this MSLP program if we've got other, existing products that we can help our clients with? So there is a notion of kind of competing with the existing debt options that the banks have. But in general, I would say half of the banks that I've talked to are interested, the other half not so much. And in general, for the clients that they're looking at, it's existing clients, not necessarily trying to bring on new clients with this product.
Yeah, I think that's well said, KD. Certain banks are focused on existing clients, certain banks are focused on new clients, and pros and cons to both, so just know all your options there. Want to talk about some of the FAQs from our last webinar, and we're receiving some good questions here, so I'll kind of go back and forth. I don't plan to hit on all of these questions here. The MSLP pre-program, it's been in place for about a month now, and loans have been underwritten and loans have been sold to the SPV. So the program is underway. The volume has been much less than I think the Fed and Congress would have hoped at this point. There's a full 80-page FAQ from the Federal Reserve available. It just gets longer and longer, and I do encourage you to review that. Some of these questions, we've put the actual location in the FAQ for the answer to this question. So we'll just hit on a couple here today. The first comes up very frequently. The PPP does count towards your EBITDA, your funded debt, and the portion that has not been forgiven will count. If it's been forgiven, it does not count.
And one quick note, James, on the EBITDA calculation. I think this is one point to drive home as well, is when banks are underwriting these products, there's not a whole lot of variation between how they were underwriting products prior to this MSLP loan and now what this offering is. So I've had the question of, well, how is EBITDA going to be calculated for the limitation? And short answer is it's no differently than it's always been calculated, right? So you take all your existing debt, including the PPP debt that has been taken out, whether it's in a forgiven stage or not just yet, and that's going to be included, and that's part of the underwriting.
Absolutely. Thank you, KD. Jason, when you look at the lender certifications here, we got this question through. Does it cause you to prefer other in-house loan products? Can you give any color there?
Sure. We vetted Main Street, institution-wide. So, our chief operating officer, our president, our outside legal counsel have all looked at it, and we're all comfortable as an institution in proceeding with Main Street. So on any specific requests, it's just been all vetted in advance. So I at least in our institution, I wouldn't be concerned at all with the lender certifications.
Yeah, we've seen that as well. If lenders are participating, they are participating. It's really a question of fit and making sure the loan fits the potential client's needs, potential company's needs. Are you serving existing clients and new clients? I think we've talked about this one. I want to go to a question that comes up that we've gotten a few questions about, this restrictions on shareholder distributions. Jason, can you talk a little bit about your perspective there, and for these MSLP loans you're considering, what are companies allowed to distribute out to shareholders and what are they not?
Sure, good question. So this comes up, for the larger companies because the compensation is set at no more than you took out in 2019 as salary. You can bump that up to 425, and that's where the starting point is. But if you're a company that, the owner, took out distributions in prior years rather than wage, you can't do that with MSLP. So what you need to do is you can bump your salary up to 4.25, and you can take out enough in distributions just for taxes, but you can't distribute above and beyond that. For the smaller companies, it's a non-issue, and then you're always entitled to take out distributions. If you're an S corp, you can take out distributions for taxes. But we've taken a pretty hard line on that. It doesn't really work too well for management buyouts. It doesn't work for any type of recaps where shareholders are trying to change. It wouldn't work in certain instances for PE firms. But I do want to emphasize that PE firms are allowed. So again, the purpose of this is your company was great, then it struggled because of COVID. So we want to lend you a bunch of money that's government backed at lower interest rates and more favorable terms. But in exchange for that, we want you to keep the money in the company for the duration of the loan. And it's even required, the same limitations are 1 year past the termination of the loan.
I think that's well said, Jason, and exactly. If you're making distributions above and beyond tax distributions, those would discontinue over the life of the MSLP loan, and 1 year after. There is some wiggle room on the compensation to increase your compensation up to the 425, just as Jason said there. This has been a material pausing point for companies that are profitable and performing okay in this environment. This continues to be a sticking point. I'm going to skip to the next page here because I've seen some questions come through in the chat box here on this one. Is a personal guarantee required as part of the MSLP? It's not formally required as part of the MSLP, but a lender may still require it. And KD, maybe you can just talk about some of the questions you've seen come up here related to what the MSLP program is describing is the process versus what lenders are describing as the process.
Sure. Yeah, like I previously mentioned, the underwriting process, I think, is going to look very, very similar to a conventional debt financing that you would go out and get when the government's not involved. Looking for audited financial statements, while you could probably get by with tax returns based on what's listed in the MSLP program. I think most lenders are going to require some level of third-party assurance on financial statements, whether it's audited or reviewed financial statements. To James's point about personal guarantees not being required, I agree. I think lenders will still look for something like that if depending on the leverage situation of the borrower. So really, I would talk to your banker and understand what their appetite is. You know, they're going to understand what the MSLP borrowing requirements are, but they're going to have a better insight as to what their own underwriting and you know, lending committee is going to stomach when it comes to handing out money for something like this.
That's right. Jason, anything you'd add here?
I'll add that we're representing to the government when we underwrite these things that we are underwriting them just as we would if it was 100% our own money, with the exception of we don't normally do 6 times EBITDA. We don't normally do 1 year of no payments. But if we normally would get a guarantee for conventional lending, we're getting a guarantee. And if we normally would take, you know, filing on all the assets, we're taking a filing on all the assets. So just think of it as you're asking for conventional monies, but you're just getting, in most cases, a better interest rate and more flexible terms.
Thank you, Jason. Appreciate that. And want to call specific attention here to the FAQs on this page to the audience, because there's a number of new questions coming in that relate specifically to the answers here on this page. Jason or K-Deep, what level of public disclosure are you seeing here on the MSLP, or have you heard any rumors there? I know the PPP program, that was a bit of a contentious issue there of whether or not to report the names of those who have taken the loans, or have you heard anything there?
I haven't heard anything, but if we use history as a kind of a benchmark and how the PPP loan went down, like James said, it was a contentious issue. Eventually, names were published, so I wouldn't be surprised if we go down a similar path on the MSLP program. Now, the PPP program was a much more lenient program and much more, you know, favorable, obviously, because of the forgiveness element. So it's possible that you won't see the same type of public disclosure, but then again, it's you know, I'm kind of basing it off of history, so I wouldn't be surprised if there is some type of published information out there.
Very good. So why don't we, a number of good questions coming through here, and if we can't get into them here by the end of this call, we'll certainly follow up. But we've talked a lot about the MSLP program here. What's on the horizon? The SPV, I want to say the last estimate was 13 billion of loans. The banks and the Federal Reserve and the market believe that changes will need to be made to the MSLP to make it more broadly available as an option for borrowers and lenders. For now, it acts as a good backstop and safety net in the event a second or third wave of COVID infections impairs business performance. This is an option for certain folks. There have been some rumors of potential changes to the program, including reducing the interest rate, lengthening the loan terms, enhanced lender indemnities, and or 0% risk retention for lenders, wrapping the program into the third PPP package that's been discussed as part of the Republican fifth coronavirus package, or perhaps adding additional partial loan forgiveness. Either way, the rules continue to evolve, much like they did with the PPP, and appreciate the market's patience here in understanding that. Why don't we switch gears here briefly, and we'll come back to the questions that have been asked. We want to talk about other options available in the market, senior bank lenders, and some of the additional loan products that they offer, junior and equity capital providers, and the status of those markets here today. I'll give a quick summary here, and then Jason, K-Deep, would love to hear your perspective here as well. But there's really three options that we think about when you step past the government-sponsored programs, MSLP, PPP, and EIDL. So you have senior bank lenders, the ones that we all know and have had many experiences with. focused on seniority and security and underlying collateral, deploy covenants meant to help reduce risk. Personal guarantees are part of the equation there. And this is, in general, the least expensive form of capital after SBA and government-led programs. And financing can be achieved relatively quickly here. Junior debt capital providers, these are sometimes called mezzanine capital providers. These are focused on remaining available collateral after senior lenders, and they're also focused on cash flow, near-term cash flow. They do deploy covenants meant to help reduce risk, but very uncommon to have a personal guarantee as part of a mezzanine loan structure or junior debt capital structure. This is a modestly expensive form of capital, and we typically see these in the 18 to 15% required return. And financing takes a little bit longer given the risk profile, frankly. Equity capital providers. These are investors into privately held businesses. They're focused on cash flow and long-term prospects of the business. No personal guarantees or covenants. They do deploy sometimes control provisions to help limit certain actions of the company, but this is certainly the most expensive form of capital. They do often bring strategic value to the table, or at least you want them to bring strategic value to the table above and beyond their capital. But typically they're underwriting these investments to a 15 to 30% annual required return. And again, given the risk profile, these financing events take a little longer, 90 to 150 days. So I'll pause there, and Katie, maybe you can start by just saying, you talk with a lot of business owners and CFOs, and what do you hear them asking about right now in terms of potential financing options?
Yeah, I would say, I'm seeing a shift into companies looking at private equity more so today than I have over the last, say, 5 or 7 years. I think it's starting to be more of a viable option, especially with some succession planning issues. I work in obviously the ag industry, and it's widely known that there's some succession issues with passing on the family farm to the next generation, and this is where we're seeing private equity be a very viable option. And I think another reason for that is historically we've seen private equity, when they look at a deal, they want a majority stake, right? Or at least some type of eventual warrant or something that they can exercise to get them to a majority ownership in a business. And we're starting to see private equity relax a little bit on that, and potentially even take a minority interest depending on the long-term prospects of the business and what the existing cash flows are. So I would say private equity seems to be a more viable option today than it historically has. In most cases, my clients have gone to your typical bank or some kind of mezzanine financing option secondarily, but now that private equity option is more widely known and understood.
Yeah, and I want to echo that comment Katie made, is there are more equity capital providers willing to do minority investments than ever before. It was frequently always control based, but now they've found they like partnering with owners and management teams, and they're okay in purchasing a 15 or 30 or 40% stake, so long as the company has good performance, good balance sheet, not over levered. But Jason, maybe you can talk a little bit about on the senior bank side, what are you seeing clients asking for in this environment?
Well, another good question. One of the things that we've seen is, there's definitely a bump up in the rates in general from senior lenders, and it may not be in their spread, but there's just an enormous amount of floors that have been put into new deals. So I think the rationale is that, the Fed lowered the, cost of funds to banks to essentially zero, and then asked us to continue to lend monies, which we're more than happy to do. But if you were, a LIBOR, 250 or 300 borrower before, you may still be a LIBOR 250 or 300 borrower, but we may put or the banking community may put a floor on LIBOR of 1%. So we've seen a kind of a bump up in the global rates for borrowers. As you know, banks are being asked to take on what's perceived as more risk during the COVID times, and we also want to maintain our margins. And when the Fed dropped rates to near zero, we kind of countered that with a floor. So I think that's the biggest change that I've seen since COVID happened. But there's still capital out there. There's still loans being made. There's still banks that are being aggressive. Just again with the floor rates.
So, Jason, thank you. We've seen the same in general. Interest rates are increasing slightly. Again, with the uncertainty in the market here today, have you seen any change in advance rates, either on equipment loans or real estate loans or building loans or working capital lines?
I haven't on equipment. I haven't on working capital. On real estate, absolutely. So if you're in real estate and you've got a hotel, for example, that was functioning phenomenally well pre-COVID, it's going to be tough, but there are banks that'll do 50% LTVs. Those used to get done at between 65 to 75. If you've got office buildings or you've got retail real estate, again you might be looking at 50% LTV stuff. So I think it's more impacted by our approach to real estate, because real estate is the most uncertain asset class out there. I'm talking about commercial real estate, not residential. Residential seems to be just fine. But we haven't seen a change in inventory advance rates, receivable advance rates, or equipment advance rates.
Yeah, thank you, Jason, and that's helpful as folks ascertain their financing options. The rates are certainly one component, but access to capital is certainly another component, and a number of options out there for folks to consider. Echoing K-Deep's comments earlier, ask your lender, reach out to your lender about the MSLP, how they're viewing the program, how they view it comparing to other loan products that they offer in-house. There could be different options available for you. So shifting gears here a little bit, we've got. I'm going to provide a little bit of additional information on each of these three, just to make sure that we cover these comprehensively, and then I want to shift to some of the questions in Q&A and give everybody a chance to ask any questions that they might have, or if folks are shy on the phone, then we'll go through the questions that have been submitted here. But again, senior bank lenders, they're focused on collateral and security right now. They're eager to lend. They really are. They're having difficulty finding high quality assets to lend to. That of course is a focus area. The Federal Reserve Bank, Treasury, Congress have all initiated programs to help banks lend to perceived riskier assets. And so that is helping add liquidity to the market. The market for senior bank loans certainly broadens when you're looking in the 5 to 50 million range. There's a number of options available to companies in that size range. And of course, they'll expect sufficient collateral and cash flow to lend those amounts. One way to be really well prepared for these discussions is preparing 13-week cash flow and full year cash flow forecasts, in addition to a business liquidity assessment. And what that means is understanding what your liquidity is, what your potential borrowing base is, and how advanced are you on that borrowing base, and what kind of capacity might you have to take on additional financing and service that debt. These are all things that you can begin pulling together now and being very well prepared for these discussions. Junior capital, mezzanine capital providers, again, focused on remaining collateral after senior lenders. They're okay if they're in an unsecured position. Some like to take a secured position, but there's a number out there that prefer unsecured positions. They'll price that into their capital. And again, these folks are going to need to see near-term cash flow in order to be able to underwrite junior capital mezzanine loans. given that the risk behind a senior lender here, junior capital is going to be more expensive in the 18 to 15% annual return. They do that in a number of different ways via cash interest rates, variable interest rates, equity-like instruments like warrants, or percentage of EBITDA, interest payments. They use all these methods in order to get to an 8 to 15% required return. The market for junior capital providers broadens when you get to the 10 to 30 million range. We don't typically see many junior capital providers providing less than 10 million. And so they're going to be focused on, what's the right size for this business and given its financial profile. Preparing an information memorandum and proposed financing package for junior capital providers. They're going to want to hear the story about the business, the management team, the prospects of the business. This is all important to pull together for these folks who express interest in your business. And lastly here, before we get to Q&A, equity capital providers, as Kadeep had said, there's a tremendous amount of we've all heard about private equity capital, and it's a tremendous source of capital, particularly for owners interested in selling their business. But what's changed over the last couple of years is equity capital providers and private equity firms' willingness to invest in a minority position in businesses. And they're focused on the long-term prospects of the business, the current management team depth, the growth potential of the business, the cash flow generating capabilities of the business. This will be more expensive capital, 15 to 30%, given it's unsecured and the risk that they're taking here. But there's a tremendous amount of equity capital providers out there that bring a lot of strategic value to the table: customer relationships, board members, vendor relationships, worth considering. And equity capital providers, similar to mezzanine capital providers, it's typically going to be in the 10 to 50 million range, where these folks have an interest in investing. And certain circumstances require equity capital providers to step in and support a business throughout major events in the company's life cycle. And we talked about ownership sales. We talked about COVID. These are significant impacts on operating companies, and equity capital providers can really help companies bridge the gap here. And similar to mezzanine, preparing an information memorandum and proposed equity financing package for equity capital providers will really help investors feel confident about the management team, understanding of the opportunity and the plan moving forward here. So with that, again, we're not going to touch on the PPP and EIDL today. There's a number of different webinars and content out there covering those programs. We want to offer here a few minutes, while we have 5-10 minutes left here, an opportunity for folks to ask any questions of Jason, Kadeep, and I. And so why don't we pause there?
James, while we wait for someone to come up with a question, I want to address a couple of the questions that I'm seeing on the screen that jumped out at me because I thought they were really good questions. I mean, we're getting a wide array of really good questions, but this one in particular I've just dealt with recently, and I could shed some light on it. So the question was, since PPP has not yet been forgiven, will the lender assess the level of forgiveness anticipated? I'm actually going through this with an existing client where they took out a PPP loan and they're in the middle of refinancing some debt, taking on some new debt, and the lender has conditionally approved that package. However, one of the conditions was that, we want you to get forgiveness of the PPP loan and legally get that forgiven from the SBA. So it appears that the banks are taking a position that, we want to see that you've now gotten it forgiven. The tricky part about that is we don't know how long it's going to take on some of these for the SBA to finally give a release. And so we're working with that particular client to say, let's put together a package that documents that you do qualify for the forgiveness because you meet all the attributes, and see if the bank will move forward with that level of documentation as opposed to getting a full release from the SBA. And then another question here that I'll cover real quickly is for a smaller company that doesn't currently include capital leases on their financial statements, do we need to add that into the debt calculation? Our short answer is yes. And there's a new accounting standard that's coming out that's going to essentially take all leases, whether they're capital or operating leases, and put those on the balance sheet to be in conformity with GAAP. And so the answer is yes. Banks are generally going to look at your existing lease obligations when they're underwriting any kind of loan.
Thank you, KD. Very, very helpful. A couple questions that I'm seeing come through here is, can you use the Main Street loans for acquisitions? Absolutely. For growth capital, for acquisitions. That's what the proceeds are meant to be used for, in addition to helping sustain operations through this. Any other questions or from folks, or otherwise we'll jump to some of the ones that have been sent over here. Are you seeing at all QOEs needing to be required, Jason, as part of any of these underwriting any of these loans?
We are not. I think part of that is that, even on these really large requests, I mean, if you get a $25 million, Main Street request, you're really holding $1.2 million of exposure. And we, as an institution, have not required them. However, I would say that if, we had done another loan of similar size, and we had required the Q of E, then I would say we should require it, because we're, as an institution, trying to do things similar to a conventional loan. So if it's normal and customary to get a Q of E on this specific request, I would say yes. I just haven't had a request that had a Q of E element to it yet.
Agreed. A couple questions that have come through here, Jason, relate to shareholder distributions and shareholder loans, and there's several different questions that have come through here, trying to get to the same perspective. Is there any way to get around it? And so, have you seen? Is it possible for a shareholder to, instead of distributing capital out to themselves, they distribute it to the company as a loan?
No, I mean, we're pretty sticklers on that compensation. I mean, everybody's asked, like, well, can I do this, 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 and this? No. So the answer is, you can match whatever your salary was for 2019. But any distributions, any change in capital structure, any of those things, at least at our institution, we're not being flexible. We're not, changing the spirit of Main Street. The spirit of Main Street is, your company was impacted, major crisis hit. We need to keep the business afloat. We need to make, in some cases, have the business grow, but we don't want to see this as a bonanza for shareholders or, private equity or whomever to, distribute capital out that's getting super cheap capital on flexible terms from the government.
Yeah, that's well said, Jason, for sure.
Yeah, I agree completely. And thank you, Jason. A couple other questions that seem similar here are funding timing of the MSLP program. How long will it be available, and does it make sense for businesses to wait to apply for the MSLP until after the PPP has been forgiven?
Good question. The Fed did come out and say it is extended through the end of December. So there's no hurry. The chances of the funds being exhausted seem very, very slim because there's been limited interest. If the PPP is forgiven, it's a slightly cleaner deal. And, if you can wait, I guess waiting is not a bad option. At our specific shop, we're basically assuming that the PPPs will be forgiven and we're underwriting them as such. But I know that's not universal within the banking community.
Yeah, that's well said, Jason. Most of the lenders that we talk with are still viewing that as debt, And one client that we were talking with, again, the technology company, they were already in the loan forgiveness process. They had already spent the funds and already had a good track record on it. And our recommendation was just wait a few weeks here, get the PPP paid off, and then that's going to give you a little more wiggle room on the MSLP. Any other questions? So we've received a number of good questions. We've answered a number of them. And the ones that we haven't gotten to, we will circle back up on those. But want to offer, is there any other questions that folks would like to ask here while we have you? Otherwise, we'll give you 3 minutes of your day back. Well, really appreciate Jason and KD you taking the time here to join us today and chat through this program. Thank you everybody for attending who could, and having a nice robust discussion here, and we'll certainly be back in touch here. The slides will be made available and distributed out to those who participated. Deanna, anything else that we should wrap up with?
Yeah, and just a recording is going to be available on mossadams.com within the week here. So,
if anybody, thank you, Deanna. And if anybody would like the slides, we're more than happy to share them. Just reach out, and we're happy to share them. But the webinar recording will certainly be available.
And the slides will be distributed within this week as well to everyone that participated.
Perfect. Very good. Thank you, everybody. Appreciate it. Have a wonderful rest of your day. Thanks, Jason.
Thanks, everyone.
Thanks, Katie.
Thank you.